Of course, one of the bigger stories for stock market investors in 2024 has been the growing effectiveness of artificial intelligence and the billions of dollars in investment to build capabilities to deliver artificial intelligence to enterprises worldwide. One of the companies that's facilitating that growth is Supermicro Computer. So let's take a look inside Supermicro Computer and try and see what's going on with this AI company as it benefits from the growing investments in artificial intelligence. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So like I mentioned, Supermicro Computer has been thriving as investments in AI are increasing. And for their fiscal year in 2024, they achieved $14.9 billion in revenue, which was a 110% increase year over year. To put that in perspective, their fourth quarter revenue exceeded all year revenue from 2022. That's how quickly Supermicro Computer is growing. Their growth rates are similar to that of NVIDIA. Supermicro Computer and NVIDIA have been the two companies growing at phenomenal rates over the last year and a half. The big difference between Supermicro Computer and NVIDIA has been profit margins and cash flow. NVIDIA has delivered significant growth in those two metrics, while Supermicro Computer has not grown as much as NVIDIA has in those two other metrics. Now, Supermicro Computer helps build and optimize rack-scale plug-and-play solutions with the latest DLC liquid cooling technology, helping their customers achieve the best time to deployment, time to get online, and lowest total cost of ownership with their AI solutions. And this service has attracted many customers, as you see with the phenomenal growth rate, and Supermicro Computer has the largest backlog it's ever had in its history. So demand for its products and services are increasing exponentially. They could have done even better, management said, if it not were for some DLC component shortages. If they didn't have these shortages, they would have delivered hundreds of millions of more in revenue in their latest quarter. Their fourth quarter non-GAAP earnings per share of $6.25 were well ahead of the $3.51 last year, and that was a 78% year-over-year growth. Their earnings per share would be even better if they could improve their profit margins. And management, as I'll discuss a little bit later in the video, has plans for increasing those profit margins to be sure. So those component shortages we talked about earlier delayed about $800 million of revenue to July, which lowered their earnings per share, but it'll be recognized in their upcoming quarter, in the quarter that'll end in September. Furthermore, the availability of their Malaysia facility, which is a new facility they're bringing online later this calendar year, and their dominating position in liquid cooling solutions will be instrumental in increasing their profitability. So management is forecasting when they bring that facility online, it will be instrumental in increasing their profitability. Now, I don't expect that to happen immediately when they bring this facility online. I suspect more of these benefits will come to the company in 2025 because it takes time to ramp up manufacturing. It takes time to optimize manufacturing. And so you don't see the benefits immediately as soon as it comes online, but you do see the benefits over time when you add scale and when you have consumer demand as robust as Supermicro Computer has. Increasing your scale allows you to lower your total cost per unit or your cost per unit, and thereby increases your profit margin because you now have greater scale. Now, more data centers will be opting for their latest DLC liquid cooling solutions, which dramatically improves the total cost to ownership relative to traditional air-cooled data centers. And the costs of these new AI data centers are increasing so much so that these large hyperscalers, think of companies like Alphabet and Microsoft and Amazon and Meta platforms that are spending tens of billions of dollars on these AI data centers, cost is becoming increasingly important. And so they're looking to save cost wherever they can. But there's another reason why lowering energy consumption has become more important. And I'll talk about that in a little bit. Supermicrocomputers solutions help customers save energy costs up to 40%. That's a meaningful savings. But it also pulls in customer data center lead times, or to be more precise, reduces their time to come online because of less electrical power required. And one of the headwinds I've been noticing from these companies that I've been following that are trying to build the AI data centers is power requirements. The AI data center has such a power requirement that you can't just build it anywhere. You can't just go buy some real estate somewhere and say, all right, we're going to build an AI data center right here. You can't do that. You have to secure power for that data center. You've got to talk to the utility in the region and make certain that that AI data center is going to be able to have enough power to operate. And if you can lower the power requirement for that AI data center, that opens up more opportunity to actually build that AI data center because the power requirement is lower. And so the areas of potential additions of these data centers increases. And so you have more options, and that makes it easier to actually build these AI data centers, which is becoming increasingly important because companies are having difficulty finding locations that have enough power to support another AI data center. So what does all this mean for supermicrocomputer stock investors? Well, you probably noticed that the stock price fell by close to 20% following the company's latest earnings release. One of the primary reasons the company's stock price fell following the earnings release was a decrease in the company's profit margins, a decrease in the gross profit margin, and a decrease in the operating profit margin in the latest quarter. Well, one of the reasons those profit margins fell was because of the delay in revenue, the $800 million from this quarter to next quarter. So part of that will fix itself, just a timing issue there. Secondly, those shortages will be helped as time goes on, as the supply chain works to absorb this increase in demand. And finally, those new manufacturing facility coming online later this year is not going to help improve profit margins immediately for Supermicrocomputer, but longer term, it could have an upward trajectory on the company's profitability. Additionally, one thing we didn't discuss in the video is Supermicrocomputer's negative cash flow from operations, which are also decreasing the company's attractiveness among investors. So in the near term, there are some headwinds that Supermicrocomputer is facing, but longer term, you'll notice demand for the company's products are soaring, revenue is soaring, customer demand is soaring, and so Supermicrocomputer, the task in front is to be able to execute on those customer orders. And that's not an easy thing to do. It's not an easy thing to grow your revenue by more than 100%. And while you're doing that, adding new manufacturing facilities, bringing on new products, bringing on new customers, it's a challenging task. And so investors are not as confident that Supermicrocomputer will achieve this task effectively. And so the stock price is facing near-term headwinds. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.